Everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and today we're going to be analyzing KLA Corp stock, ticker KLAC. This one came in by request down in the comments section of one of my other videos. If you have a stock you would like me to analyze on the channel, just put it down in the comments section. I'll get the ticker on the whiteboard behind me, and eventually I'll make a video. If it's a stock that's in the S&P 500, I post those here on YouTube for free. If it's not, I post the rest on Patreon and in the full Cyclical Investors Club service over on Seeking Alpha. If you join Patreon, which is $5 a month, you can get a big discount to the full Cyclical Investors Club service if you ever decide to join there. Those links are all down in the description. I also have a link for Fast Graphs, which is the charting service you'll see me use here for 25% off if it looks interesting to you. If you use that link, you can get a discount, and it helps out the channel a little bit too. So, as always, this is not individual investing advice. This is just how I analyze stocks. So the first thing I check with any stock really, but with KLA, is the earnings history, right? And we can see that during, especially the cyclicality of earnings, and we can see that during the Great Recession, they actually had a year where they lost money. So if we zoom in a little bit, we can see it more clearly. A brief fall down here, a brief year of losses, and then they immediately bounced back. This is pretty typical for like a semiconductor equipment company. Usually they're not quite as cyclical as the semiconductor makers themselves, but they still, are part of that same cycle. So this industry in general has been, well, before I go into that, let's zoom back in real quick here. So the first thing that's important is with a deep cyclical business, it's really difficult to use earnings as a valuation metric. So if you were to use them here, like a 13 looks like a wonderful time to buy the stock, but then it went on to fall another 60% basically. And if you were down here at the bottom, if you were going to buy, well, there wasn't even a PE, but like right in here, the PE was higher, like 30, 40, 50, 60, right? This is when you should have been buying, but it looked like it was really expensive if you just look at the PE. That's because the earnings fluctuate so much up and down. Again, right here, it would look super cheap because those earnings were near a peak, right? So it would be like, oh, this looks cheap, but then you look 2 years later and the earnings are coming down, right? So then you just basically have to ignore earnings, other than you want to make sure that they actually are earning money over time, and that the higher earnings highs, that the earnings peaks continue to be higher, and the earnings troughs hopefully continue to be higher as well. But sometimes the nature of these types of businesses, they will continue to lose money occasionally during down cycles, right? So we should just be careful and kind of ignore earnings would be my main first takeaway. And we did have a little mini down cycle here in last year, basically. Well, I guess it's going into this year. So earnings are expected to be lower than they were for these guys in fiscal 2023. And we'll see what happens. It's very difficult to know how much earnings will fall or rise. But the market is expecting this to basically be shallow and then to go up and to the right after this. So that's what the market thinks. Now, I did write one article on these guys for Seeking Alpha right near this trough, because it got low enough where usually once these cyclicals they're sold off the highs, I usually try to write an article where I share where the price where I'll look to buy them if they get like super cheap. So and I try to share that ahead of time. And so that's what I did with this article on October 27th. So it was a neutral article. The stock's up 125% since then. So it did not hit my buy price. It actually didn't really get too close. My buy price was 137.14 and it bottomed at 250 basically. So, I mean, a little close when you consider that it peaked at, is that before then or after then? Yeah, it peaked about 450, we'll say. Or no, yeah, 450. So 250 is a lot lower than 450. but it didn't quite get low enough to buy it. So, and really, this whole industry is tough because it is a secular growth industry. That means the overall trend of earnings is going to be more and more demand and higher troughs. So, when you use a technique like I do that looks at past declines, it can make future declines or current declines be not as deep as they have in the past. So, but you never know if that's going to be the case or not. There's a lot more factors, so you just kind of have a rough judgment, but it really does make it hard to gauge with any confidence like how far it will go. So I watch a lot of them, and then I hope a few of them will hit my really cheap buy prices, and that's enough to for me to buy them, right? And that wasn't the case with this one, but I've been able to buy different ones. I bought some in 2020. I actually bought Micron in like 2019 or 18 when it was super cheap. I was able to get Micron again, and I was able to get AMD, Microchip Technologies I got in 2020. So I get opportunities, but we haven't had like a 2008 style or anything even close to it type of pullback where there's more than one thing like working against. So you can have like a semiconductor down cycle, but it didn't happen at the same time as a recession this time. So, but it could have. So we kind of had a bust from the pandemic stimulus and the kind of global trade lockup that happened, supply chain issues, right? So we had a bust after that, but we never really had a recession. So some of that potential decline happened. If you look at just how far it fell, it says 40%. This isn't like exact peak to trough, so it's probably more like closer to 50. Well, 460 to 250. So yeah, maybe 40 to 45% decline. That's a significant decline if you're one of the people that was buying around here, right? And so if there would have been a recession as well, it would have gone lower. But that's just not how it played out this time. So the question now is, we're at all-time highs, all right? So what to do? Well, one, again, ignore the PE. I wouldn't really do anything with that. I try to just buy it when it's a certain percentage off the high. And the way I do it, try to figure that out, is I look at the past declines that this stock has experienced. And then I have other factors too, but I'm just not going to get into those right now because they're not relevant if I was going to buy this stock. If you look at my Albemarle video, that's a deep cyclical that we actually have bought on the, I shared a buy video on the YouTube channel. You can get into that a little bit more. But if we look at, this is the 2001 era, or around there. It fell 75% of its highs. 2008, it fell 75%. And then, I don't know, I think this was 2020. And it probably happened again in 2022, about 45%. So 2020 was very quick because there was all the stimulus and the pandemic. The way it played out was there was actually more demand for like electronics and semiconductors. So that was a shallow one too. So we have kind of basically these two types of declines that it can experience. Now, if a person made a judgment call about whenever the next decline comes, they said, well, this could be a shallow one. I'm going to buy when it's 40 or 45% off the high. Yeah, go for it. I mean, just be aware that you could have to sit through a 60% drawdown from there if there is a steeper decline. You just kind of have to be aware of it. There's some stocks that I have, like Micron, that I have two different buy prices for. My basic limit for a deep cyclical like this is I'm not going to buy it before it's at least 50% of its highs. So I probably wouldn't have been able to get into this one anyway. I like to at least get a double out of these for putting up with like the risk and the volatility and everything else that kind of goes along with it. But there's nothing wrong with it if a person buys at 45% or 40% off the high, as long as they understand what's possible. Like, so imagine you buy a stock that peaked at 100, you buy it 40% off its high at $60, and it eventually falls to $25. Well, you're down like 60% off of your initial price. And sometimes what happens is people don't understand that. They think, man, I got a great deal. I got it 40% off the high. this is a great company, blah, blah, blah. And then it's one of those years where the company's earnings go completely negative, and then this investor gets down 50%. Most of the time, they will sell at some point. There's just too much pain. There's a reason why the prices get that low. It's because people, they're buying on the way down and they're getting killed. And they don't understand usually why they're getting killed, and or they think that the business is just going to hell because earnings is just collapsing. And that's normal. And if you know it's normal going in, then you can deal with it. It's never pleasant. But I've had my share of stocks fall 50% and come back, and I still make 100%. So if knowing is half the battle, from the old G.I. Joe cartoon or whatever. But then it's okay. But most people, they don't. They'll buy it 25% and then they'll buy again at 40, and then they're down like 60%, and it's just more than they can handle, and they sell, and that's what takes it from 60% down to 75% down. And then that's when I like to buy them when I can, because it's a huge return. I mean, if you're able to buy when it's something's 75% down, so you think you buy that $100 stock at $30, well, you get a double when it goes to 60, you get another double when it goes to 90, and you get another 30% when it goes from 90 to 100. So that's a 230% return if you do get one that successfully hits and recovers from that type of decline. It doesn't mean you couldn't buy earlier and still get great returns, but usually I aim low. This is one I probably would step in and be okay buying when it's like 50% off the high. I mean, it kind of depends what's in the portfolio. I follow enough. If you don't follow as many stocks as I do, you might also want to consider buying a little sooner, right? Because I have other things where I'm looking and I'm like, well, usually there's going to be more than just this one stock that's falling. I'm going to have a bunch of others, and so if I buy half of them, I have a pretty good position in semiconductors or whatever. But if a person isn't following as many stocks, they might not have as many opportunities, so they might want to be willing to buy a little bit sooner. So that's another consideration too. But so yeah, 70, it's almost at a high now. So I mean, 70% off where we're at is about $200 a share. Like I said, you could do 50, which would be what, like 340, nothing wrong with that. As long as you understand that you could still lose another 50% before it rises again. But I do think this is a high quality business, which is the biggest challenge. The next biggest challenge is getting at a good price. The next biggest challenge is holding through the volatility and literally ignoring everything. I mean, because the news will be legitimately bad. It will be scary and bad. And everything you see will be, just about how horrible everything is. And then you'll look and they'll be losing money maybe. And that's when you want to hold if you've already bought, and just put it off to the side and just wait. And that's also one of the reasons why you want to aim for a big return, because you might be waiting a few years. If maybe we had a recession this year and the stock had fallen, already last year. Well, you wait a year, there's a recession, now you're down farther, you're 2 years in, and then it takes 3 or 4 years to recover. You want to be able to go through that whole process and have gained enough where you go back and your CAGR's like 15-20% still over that 5 or 6 years. So you can be more patient the lower that you buy, because the reward in the long run, if it recovers, and I usually only buy the ones I think can have a history of recovering, so is enough to justify just waiting. And you can kind of just ignore the news, hopefully, and hold. So that's my KLAC, KLA Corp analysis and buy prices. Again, 50% off is about $340. I would definitely be buying if it got down to like the 206 mark or close to it. And maybe I'll buy a little sooner, just depending on how things look, if it ever happens. Okay, if you found this useful, hit the subscribe button, drop a like. If you have a request, put it in the comments section, and I'll see everybody later. Bye.